Good morning investors. Today is 3rd September and in today's video first we will discuss Indian market trends, then some important market news, and towards the end we will discuss some stocks that are showing some growth triggers. So let's start. Starting with Indian market trends, this is 5-minute chart of Nifty 50. As we can see, Nifty opened in green, showed a strong momentum, but during the midday, market roughly corrected by 0.94% and closed down at 24,579, that is roughly 0.18% down. This indicates that market is not able to sustain the momentum despite of being backed by strong GDP numbers. However, yesterday was Nifty 50 expiry as well, so there was a possibility of manipulation at index level as well. Now in the earlier videos we have already discussed that FIIs are not at all concerned with our GDP number. For them, other Asian countries like you can see China, South Korea, Indonesia and Taiwan are trading at lower P valuations. You can see the range is between 10 to 16. However, if we look at Nifty 50 PE valuation, then it is 21.6. Now against the PE ratio of 21.6, the earnings growth rate of Nifty 50 companies was 7 to 8%, which is really very disappointing. And due to this, again yesterday FIIs were net sellers. From this data we can see that yesterday FIIs have done net selling of almost 1100 crores. However, DIIs tried to support the market with the fresh buying of 2550 crores, but this has been 7th day consecutively where FIIs have been net sellers. Now one thing more to note is that yesterday however Nifty closed at minus 0.18%, but small cap and mid cap have shown good performance. Small cap was 0.53% up, micro cap was 0.85% up, mid cap was 0.27% up. Now lately market has seen various positive triggers like your strong GDP data. However, we have discussed earlier that this number is backed by government spending, but still 7.8% is impressive number. We have seen rate cuts by RBI, we have seen GST reforms expectation, but still FIIs are not ready to be net buyers. So now the only and the biggest trigger that can bring upward momentum back in the market is strong Q2 number by Indian companies plus good guidance by corporates as well. If we look at options data, FIIs still have negative open interest indicating their bearish view on the market. On 1st September, however, the negative open interest rate was 2.48 lakh, but for 2nd September, it has increased to minus 3.36 lakhs. That means they have increased their bearish stance. Now, one thing to note here is that options are zero-sum game in nature, meaning if we take negative 3.36 lakh open interest of FIIs, negative 1.62 lakh open interest of proprietary traders, and 5.33 lakhs open interest of client mean retail, and also if we take DIIs minus 34,569, and if we collectively add these figures, then we get a zero number. This means in entire option game there can be only one winner. If market rises tomorrow, then retail will make money and FIIs, proprietary traders and DIIs will lose money. However, on the flip side, if market falls tomorrow, then client, that is retail, will lose money and FIIs, proprietary traders and DII will make money. You might notice that DII have very low number of open interest. This is because in India, mutual funds are not allowed to trade in options. Only category 3 alternative investment funds are allowed to trade in options. That's why this number is very less, 34,569. Now it's up to you whose side you want to take, that is FI, proprietary traders or DI, or client or retail. Now another reason for FIIs to have a bearish view on Indian market is falling rupee. As of now, Indian rupee is close to 88 rupees per dollar. Now for a second, let us think from perspective of FII. In India, interest rate is at 5.5% and in US, Fed target is around 4.25% to 4.5%. So difference is almost 1.25%. This means rupee is expected to depreciate against US by 1.25%. Now this is a theoretical expectation. If we look at the actual data, 1 year back, rupee was almost at 84 level, 83.93 to be precise, and currently it is at 87.99. that is roughly a fall of 3 to 4%. So for FIIs, their 4% returns are directly gone, while they expect a depreciation of only 1.25%. Whereas if you see 1 year performance of other Asian markets like Taiwan dollar has given a 10.6% appreciation, South Korean won 6.4, Thai baht 5.2%. Other Asian markets have done good, and India was the weakest. Now for FIIs, it is a double benefit. First, their currency is appreciating, plus their markets are also cheap. This is the reason why we are seeing continuous selling by FIIs despite of positive triggers like recent RBI rate cuts, strong GDP numbers, GST cut expectations. So the only trigger which can bring upward momentum back is strong Q2 earnings. Now let's discuss some important market related news. First one is that government has now allowed production of ethanol from sugarcane juice. Now what does this mean? Let me try to explain. See, from sugarcane, sugar companies can either make sugar or ethanol. Now, in case of ethanol, EBITDA margins and profitability is better than producing sugar. So, in any capitalist economy, sugar companies will prefer to make ethanol rather than sugar. Now, this will lead to shrinkage of sugar supply in market and will result in higher prices of sugar. Now, sugar is a commodity which is being consumed by rich, poor, middle, everyone. So increase in sugar prices will put burden on poor and middle class person budget, and government doesn't want that. That's why government has some restriction on ethanol production from sugarcane juice. Now government has eased these restrictions and have allowed sugar companies to go for higher ethanol production. That's why yesterday sugar companies were in good momentum and some were up to 12% up. Now the question is whether you should buy sugar stocks now or not. But before answering this question, let us try to understand the rationale of government why they have allowed higher ethanol production from sugarcane juice. Now government has stated that due to good monsoon, sugarcane supply will be higher in the market, and even if ethanol is produced from sugarcane syrup, it won't affect the supply of sugar. But what I feel is, since our government is on the mission to promote E20 fuel and some private companies connected to government might benefit from this, that's why government has eased these restrictions. But no one knows what's the actual reason is, and let's not go there. Let's come back to our question whether you should buy sugar stocks or not now. Before buying, one has to consider that sugar is a highly regulated sector. Your raw material prices are fixed by government, your final prices are fixed by government, how much sugar, how much ethanol you can produce is fixed by government. So your profitability and EBITDA margins are highly dependent on will and wishes of the government. So from the long term perspective, sugar sector is risky to hold. But talking of short term, due to this upliftment of restrictions, we can see improvement of profitability in sugar companies and good earnings in the upcoming quarters. So if you want to make entry and want to ride the trend, the golden rule for riding momentum is to ride the trend as long as stock price is above 200 DMA and exit when the price come below 200 DMA. Now this is the chart of Sri Renuka Sugar. This stock has not even crossed its 200 DMA, still below. So if someone is planning to buy this stock, then wait for the price to cross 200 DMA and try to ride the trend as long as the stock is above 200 DMA. Disclaimer, I am a SEBI registered research analyst, but before taking any buy call, please consult with your financial advisor, do your own research, as I might not be able to update you with the future developments of this stock in the future. The next news is TCS has announced its salary hike, and it is in the range of 4.5 to 7% for almost 80% of their staff. Now for TCS, it is a very good news. Why? Because earlier they have done 12,000 layoffs. Now they have done such a very small increment of their employees. For them, dollar is also rising since they are exporter, their revenue is in dollar. So in upcoming quarters, we can see improvement in margins of TCS. But if I look at a broader picture, then 4.5 to 7% is as good as almost flat growth. This means company is not able to grow its earnings. Even if you look at TCS numbers, you can see revenue is almost flat, 62,000 crore in June 24. June 25 it was 63,000 crore. Profit is flat, 12,105, 12,819. See, these factors like dollar rising or since you have laid off your employees, your employee cost will come down. These factors are very like temporary, are not long term or sustaining factors. The main thing which we want is that their revenue should rise, and that will be an important number to look in Q2. And we have discussed in the earlier part of the video as well that Q2 number is going to be very important. Now let us discuss some stocks that have shown some growth triggers lately. First one is Quadrant Future Tech. Company has received an order of 128 crores from Railtel for Kavach systems. Now if you look at the fundamentals of Quadrant, you might think that fundamentals are not that attractive. Sales are almost flat, operating profit is negative, net profit then eventually will also be negative. The main thesis which can play for Quadrant Future Tech is if you look at their order book, it's currently for Kavach division is 984 crores, and if you look at their sales, it's almost 154 crores. So almost they have 6 times order in their hand. Where is the problem? The problem is if you look at their con call, they have not yet received the safety certification approval for their Kavach orders. Once they get the safety certification approval, the number will start reflecting in their revenue. This order book of 950 crores has a timeline of 12 to 15 months. So from 151 crores sales in the last FY25, if the safety certification is if they receive the safety certification, then you can see a multifold jump in revenue. Apart from this, the stock, if you look at the shareholding pattern, it is being by a star ace investor Ashish Kacholia. Bengal Finance and Investment Private Limited is his firm, and currently in Quadrant Future Tech he holds 1.55%. From price perspective, the stock is now trading almost at its IPO listed levels. Now this is not a buying recommendation. I am discussing some stocks which you can study where growth triggers are being shown. Next one is Advait Energy Transition. As you all know, India is witnessing a huge power capex cycle, and company is in power transmission and distribution space. This company has also received an order of almost 70 crore rupees. Let me show you. Here is the announcement, and if you look at the value of order, it's 71 crores. If you look at the value of order, then it is their last year sale was 400 crores. 71 crores means that almost 17%. Company has a guidance of 50-60% growth, and this order execution timeline is 12 months. Let me show you 12 months. So although company is already having the order book of almost, I guess, 700 or 800 crores, please recheck this number when you study this, and this 70 crore is a huge order for this company. If we look at overall fundamentals, year on year basis, company is growing. And if we look at the shareholding pattern, again this stock is also being backed by ace investor Ashish Kacholia, and also Vijay Kedia recently through a bulk deal by his company Kedia Securities Private Limited has made position of and acquired almost 0.92% in this stock. Now again, this is not a buy or sell recommendation. The purpose of discussing this is just to discuss some stocks with you where I am seeing some growth triggers so that you can study or keep them in your radar. And in upcoming daily analysis video, I will keep a section where there are some news or some order developments or some merger related to some stocks or some growth triggers which I am seeing in the stocks, and I will discuss toward the end of our daily videos. So that's it for today. I will meet you tomorrow.